Hi, this is LaDonna Montgomery from the EMBA Spring 2015 class for Finance 695, coming to you with Project 2, which is our company analysis. There were 18 companies used in this analysis. Those companies consisted of Intuit, Autodesk, CenturyLink, AT&T, CB&I, Fluor, Jacobs Engineering, URS, Gentiva, Tenet Health, Amadeus, Valero, Coca-Cola, Monster, energy drink that is, Marathon Oil, John Deere, Caterpillar, and Community Health Systems. Just a quick recap from my Project 1. Based on the profitability investment strategy discussed earlier, the data analysis from the regression test indicated that there is a direct correlation between profit margin and stock prices. Though this investment strategy will likely not hold up across all industries, as an investor, profit margins and market values remain very important to me in terms of my portfolio holdings. Therefore, these criteria have been my driving factors in deciding a top choice in the companies included in this analysis. So what's important to me? Well, companies that have been consistently performing profitable over the last 5 years. This means an increasing profit margin, an increasing return on assets, and or an increasing return on equity. These are very key indicators for me to show me that the company is making money and it is a viable investment option. Also, companies with increasing market value over the last 5 years. This not only shows me, but it also shows me that other investors consider this company valuable. The price to earnings ratio, which is the price per share divided by the earnings per share, and the market to book ratio, which is basically the market value per share divided by the book value per share. So the criteria for initial elimination of the 18 companies that we are working with. The first elimination is companies with negative profitability ratios. Those ratios include profit margin and or return on equity. If they're negative, I don't want to invest in them. Secondly, companies with declining return on equity. This is a very important indicator for me of how the company is being operated, and I want to ensure that my investment dollars are going to be handled with care and that I will likely return a profit. So let's see who's the first to go. These were the 10 companies that, in my opinion, and based off of the information that we used for this study, that did not have positive profit margins and or return on equities. Community Health Systems, Amadeus, Gentiva Health Services, Tenet Healthcare, Jacobs Engineering Group, URS Corp, and Autodesk Inc., CenturyLink, Fluor Corp, and the Coca-Cola companies. They had to go first. These companies on the listed chart here, these were companies with negative profit margins and negative return on equity. CenturyLink reported a negative 1.32% profit margin in 2013, as well as a negative 1.31 return on equity ratio. Tenet Health Company, a negative 1.21% profit margin in 2013, as well as a negative 14.12% return on equity. Gentiva, almost 35% negative profit margin in 2013, and unfortunately there was no data for the return on equity listed in Bloomberg. In Amadeus, a negative 7.70% profit margin and a negative 23.33% return on equity. Companies with declining return on equity: Autodesk, Community, Fluor, Jacobs Engineering, the Coca-Cola Company, and URS. All of these companies showed a decline from 2009 to 2013 in their return on equity values. Very key component in my investment strategies. The criteria for my second elimination was the companies with declining price to earnings ratios. Declining PE ratios is an indication of the stock market not placing as much value in the companies now relative to the value that they placed on them over the last 5 years. In essence, the overall investors out there don't really see this company as a valuable place to invest their dollars. The companies that fell into this category were Caterpillar, Deere, Valero Energy Corporation, and Marathon Oil Company. All four of these companies displayed declining PE ratios. As listed here, CAT declined from 28.78% or 28.78 price to earnings ratio to 16.42% in 2013. Deere went from 14.75% to 9.09% in 2013. Marathon went from 19.77 down to 14.99. And Valero went from 14.65 to 9.03 price to earnings ratio. And something interesting to me was that out of the 7 industries included in our 18 companies that we used for this analysis, the second elimination consisted of our heavy machinery industry as well as our oil and gas. Both companies, both industries had a decline in price to earnings ratio. My favorite 4 companies are listed below. They are Monster Beverages. Monster remained because of, even though profit margin decreased over the 5-year period, return on equity actually increased. CB&I, they remained among the top picks because of their percentage of change in profit margin was 6.8%, and their return on equity changed by 0.4% to the positive over the last 5 years. Intuit remained because their profit margin increased 43.05% and the return on equity increased by 41.6%. Really strong numbers for Intuit, really strong. In AT&T, they remained because they too had a very sizable profit margin increase over the last 5 years, and the return on equity increased by 62.3%. So, the third elimination consisted of 2 companies, Monster Beverage Company and CB&I. Out of the 4 remaining companies, though return on equity increased, Monster's overall change in profit margin declined. Therefore, eliminating them due to my personal investment preferences of an increase in profit margin. CB&I, though increasing in both profit margin and return on equity, it had the least amount of increase in the remaining 3 companies with both positive changes in these profitability ratios. The criteria for the final elimination. This was a really hard choice for me because both of these companies were really strong in terms of their profitability measures. Intuit, let's review again. Their change in overall profit margin was 43.05% over the 5 years studied. AT&T, right there with them at 43%. Intuit's return on equity was 41.06% change. AT&T's 62.3% increase, that is. Intuit's price to earning ratio, there was a 7.9% of change to the positive over the 5 years researched. And AT&T's, their percent of change in the price to earning ratio was 6.7%. Intuit's market to book ratio, it was 44.5% as an overall change in the 5 years. And AT&T's, theirs was almost 24%. Very strong numbers for both companies, which show they are very profitable and well-respected companies in terms of stockholder preferences. But my top choice goes to AT&T. Even though Intuit had very impressive measures from a profitability standpoint, as an investor, I was most impressed by the much larger increase in the change for return on equity of 62.3% for AT&T. When thoroughly dissected, a company's return on equity is an indicator of its profitability, its asset turnover, leverage, and overall operating efficiency. Also, my final consideration for AT&T, with the upcoming release of the new Apple technology via the new iPhone 6 release, it is expected that stockholders will benefit from the launch of this hot, well-anticipated, very popular item. In closing, though risk is associated with any investments, performing extensive research is essential to making wise portfolio selections. It is important to avoid totally emotional decisions, but rather strategic and well-balanced options. Always, always, always make investment decisions that you can sleep with at night in times of market volatility, because there is a cycle to the investing in the stock market. And lastly, keep in mind that the greater the risk, the greater the potential reward. Again, happy investing and have a good day. Thanks.